I want to go over the long-term liabilities worksheet with you guys. This should be a recap of some of the things that you possibly covered in your principles class. If you're taking the first principles, then this would be possibly just a review of some of the things maybe that you looked at in current liabilities as well. So the first question that this asked and that we are looking at is that a 1.5 year loan, so we're looking at 18 months is what we're looking at, in the amount of $100,000 with a 12% interest was taken out on June 1st of 2020, and it wants us to calculate the interest for December the 31st. So the hint here is that we are looking at what was the interest from June 1st all the way through December 31st. And so when I say here use your fingers, the reason I say that is I want you to make sure that you understand how many months we're actually looking at. So we have the month of June, July, August, September, October, November, and December. So we do have 7 months that we are looking at. And so if we do want to take and look at this, then what we would do is to find that rate is we would take the principal amount of the loan, which is $100,000. We are looking at a 12% interest rate, and we are looking for 7 out of the 12 months. Now the reason we have to do it this way is that 12% is an annual interest rate. So we need to know what was the interest for 7 out of those 12 months of the year. And so in figuring out this amount, what we would do is we would take and multiply all of this out, and I believe the number that we're looking at is around $7,000 in interest in this particular case when we do the math. So the first thing it says for B is prepare the journal entry for the issuance of this note payable. So if we have a note payable, that means that we owe someone money, which means that somebody has loaned us money. And so what we would see in this case is that on June the 1st, when we actually would take out this loan, we would have an entry to where we would be receiving that cash of $100,000, and we would have a note payable for that $100,000. And so that would be our journal entry for the issuance of that loan on June 1st of 2020. So now it wants us to prepare the adjusting journal entry for the interest expense as of December 31st of 2020. So when we get to December the 31st, we have that 7 months of interest that has accrued. And so what we're going to be looking at is we're going to have that interest expense of $7,000 that we need to make sure that has been recorded. So we would have our interest expense of $7,000, and the other side of that is going to be our interest payable, because we do owe that money to our lender. So that is what our adjusting journal entry would be. Now I do want you to remember, back to adjusting journal entries, we have to have one income statement account and one balance sheet account for all of our adjusting entries. And so we do have that. And then we're looking at, so what happens at maturity? What happens on November 30th of 2021? Well, we have interest that is going to come into play for that time period as well. And so when we try to figure out how much interest we've had for the year 2021, what we would do is we would have to look at that $100,000. We would be looking at that 12% interest that we had, And we're looking through November, so that would be 11 months. So we're looking at January 1st all the way to November 30th, which is 11 out of those 12 months. And that is going to give us interest of $11,000. And so we would have that to come into play. The interest would be for the entire time period also. So this amount is what we'd be looking at for our interest expense for 2021. We also have that interest payable still sitting out there that we need to pay. That was that $7,000. And so we have a total interest payment of $18,000. But remember, we also have that maturity of that note. And so that means that we are going to have to pay out $118,000 in this particular entry. And so, when cash decreases, it goes on the bottom as that credit account. And so what we know we're going to have this credit of $118,000. But what's the rest of that journal entry going to be when we get to November the 30th? Well, the first thing we know, we've got to pay back that note payable, right? So that note payable was at that $100,000 amount because that gets paid off. We have this interest payable that we need to pay off. And so that interest payable was at $7,000. And then we have this interest expense, what we just figured. And so we would have interest expense, and that interest expense would be for that $11,000. And so now my debits and my credits equal. I have $118,000 in debits and I have $118,000 in a credit. And so everything balances out, and that would be how you would look at the maturity point of that particular loan. And this is a long-term liability because it was over a year. Remember with current liabilities are things that are less than 1 year or less. So this one's a long-term liability because we were looking at more than a year. And so this is how it would play out when you actually take out the loan, whenever you have to accrue your interest based on adjusting journal entries, and then at your maturity date, whenever you're able to get all of that back in. The other thing that we look at for long-term liabilities that you need to be able to journalize is the bonds. So bonds are one way that a company can raise money. And so what that company can do is they can issue a corporate bond out. Municipalities can also issue municipal bonds out to raise money. Bonds can be issued at their face value. They can be issued at a discount. They also can be issued at a premium. And so there are different ways that we look at bond issuance. The only thing that I'm requiring you to be able to journalize as far as bonds are concerned are the issuance of those bonds. I am not really concerned in the principles class with you understanding the amortization that goes on when we have a discount or when we have a premium. I just want you to know basic knowledge of how that works, not the journalizing of that, because that can get rather complicated. So when we look at the bond issuance, again, we are borrowing money from someone, and so somebody gives us cash and we issue out a bond. These bonds can vary in years. Lots of times these bonds can be 10, 20-year bonds, and so somebody is agreeing to loan us money for that period of time. Now, we do have generally interest that is associated with these bonds that are paid on a semi-annual basis. But all of that's in the bond lecture as well that you can go in and you can look at. So when we actually look at this journal entry, let's just say that we're issuing a bond, let's just say, on December 1st, just so that we have that date. So I'm going to come in on 12/1, I'm going to issue this bond, and I'm going to issue it at its face value. So what this means is I am going to be receiving cash in the amount of $100,000. And the reason I am getting this cash is because somebody is purchasing a bond from me. And so the other account here is going to be that bond payable, because I have to pay this bond back at the maturity, or at the recall time, or whatever that time period is. And so the accounts that we would be using would be, the cash would be our debit account, bond payable would be our credit account. And that's going to be true for all of these, whether they're issued at face value, discounts, or premiums. Now, the difference that we get with discounts is that the bond is actually going to be sold at less than face value. In other words, we will have to pay back this bond, $100,000 bond, in the future, but we are not going to get $100,000 for it. In other words, we're having to discount our bond, and so we're charging less for our bond. And this generally is in reference to interest rates, which again is covered in the lecture video for bonds. But if you think about it, it's all a supply and demand type item. So in this case, if the going market rate, let's say is at 6% and our bond is only paying 5%, then nobody really wants our bond. So what we have to do is offer it for a lower price so that people will purchase our bond. So to figure out the amount that we actually would be issuing this for, we would take the face value, that's $100,000, and then if it was at 98, what that really means is 98% of its value, which means we're actually going to be getting cash of $98,000. So when we go in and we get this cash for $98,000, that means that we are going to debit our cash for $98,000. But now that bond payable is still out there, and we still owe these bondholders $100,000 when it matures. So at this point, our debits and our credits do not equal, and so we do have to make sure, of course, that our debits and credits are equal. So we are going to need an additional $2,000 on the debit side to have it equal out. And so that account that we're going to use is going to be discount on the bond payable. So discount on bond payable is how we're going to balance out our account. Now our debits are at $100,000 and our credits are at $100,000. The next one we look at is when we issue it as a premium. So in this particular case, this is where the going rate is, say, 6%, but we're selling, and our bond has an interest rate of, let's say, 8%. So now everybody wants our bond. And so since everybody wants our bond, we can raise that price on it because it's, highly valuable. We're paying more interest than the going rate is right now. And so it's paid at that higher amount. So to figure out that, again, we're looking at the face value is $100,000, but we're selling the bond for $101,000. So again, remember that's 101%, which means that we're actually looking at selling this bond for $101,000. So what we're going to have here is we are going to have our cash value, and our cash value is going to be at $101,000. The other thing that we're looking at here is our bond payable, and our bond payable is going to be figured in at still that $100,000 amount. So we still need to make sure that we're balanced. Sorry, you can't see that. We still need to make sure that we're balancing everything out, so our debits and our credits need to equal. So with that equaling, that means we need another $100,000 on our credit side. And so that account is actually going to be our premium on our bond payable. And so that pretty much finishes up all of these journal entries that we have for our long-term liabilities. And these are the entries that you are going to be responsible for.